Hello, I'm John Colley. I'm the 6-Minute Strategist. Today I want to talk to you about the 2012 technology IPO market because I think we are potentially at a turning point. The market in 2011 was difficult, with more than 60% of the tech IPOs ending the year below their issue price. And if you look at some of the clouds on the horizon for 2012, I think it's serious cause for concern. Let's look at some of the factors affecting 2012. You've got the bad economic crisis in Europe with sovereign debt causing a multiplicity of problems for European governments. You've got a presidential election coming up in the US, as well as some mooted tax changes which may affect the investor horizons and also the sentiment towards IPOs. You've got unrest in the Middle East with the Arab Spring. To my mind, all this doesn't add up to a great environment for investor confidence and floating on the public markets. The story behind a lot of these tech IPOs is all to do with the recycling of capital, and particularly in venture-backed companies. If they can't float their companies on the market, and I understand there are around 200 slated for flotation in 2012, then they are going to find themselves unable to recycle their capital back to their investors. They will not show, I think, the same sort of excellent returns for the investment cycle 2005 to date. This will make limited partners less willing to invest in VC-backed companies. And I think the next cycle of VC investment is going to be a more mooted one with fewer firms and less capital available. The key question is, what does this mean then for startup companies and their access to capital? I think one can draw two conclusions from this. The first conclusion is that the market, I think, in 2012 is likely to change from being a seller's market to a buyer's market. So the major corporations, Google, Amazon, Microsoft, Yahoo, no, Yahoo is probably not a good example in this case, Oracle, are going to find themselves able to acquire businesses and indeed the assets of businesses at much better prices than they have been doing in the last few years. And a good example of that is the fact that Gowalla effectively closed down with its executive team and some of its engineers being hired directly into Google rather than Google acquiring the company, which I'm sure they could have easily done. My second conclusion from this is that startup companies are going to have to get by on less capital, and they are going to have to get themselves to market, get to revenues without being able to spend hundreds of thousands or indeed millions of dollars building very complete solutions. And this, of course, brings us to the lean startup model from Eric Ries in his excellent book, where he espouses a philosophy where startups start small, they create a minimal viable product and bring themselves to market very quickly, and then iterate very fast to learn what customers want, to build their solution out bottom up as the solution evolves, and therefore their business evolves and gets larger. I put a blog post up on this. I'll put the link on this site. The blog post has got a lot more detail in it than I've given you right now, but I hope you find it helpful, and I'd be very interested in your comments. What do you think the IPOs will do in 2012? You can leave a link on my site. I'm at jbdcolley.com. I am the 6-Minute Strategist, and I look forward to seeing you on my site. And if you like it, please take the opportunity to go to jbdcolley.com/join and sign up for my mailing list and join the 6-Minute Strategist community. So until next time, thank you for joining me on this video, and I look forward to seeing you again very soon.